According to the Kenya Industrial Research and Development Institute's strategic plan for 2023 to 2027, the government aims to increase manufacturing's contribution to GDP from 7.2% in 2022 to 15% by 2027. However, the Kenya National Chamber of Commerce opines that this may remain to be a pipe dream if the tax regime in Kenya is not regulated. In the Kenya National Chamber of Commerce Business Barometer Quarter 2 2024, an unpredictable regulatory environment was cited as the second major reason why companies anticipate a decline in performance.
We need a comprehensive tax policy that will guide how tax laws are amended and how new taxes are introduced. And no investor is willing to put in their money, their skill or their time into an economy where every other year a new finance bill comes in and it might affect your business significantly or worst case run you out of business. What we're hearing from our manufacturers at the Chamber of Commerce is that the discontentment is getting to a position where they're considering moving their production to neighboring countries and then just supply back under the East African Common Tariff and sell their products to Kenya.
The Finance Bill 2024 suggests that manufacturers of excisable products are not allowed to offset excise duty on raw materials to that of the final product.
Now, that cost will be transferred to the consumers. This will make the cost of the products high, and what it does is that in general it makes local manufacturing uncompetitive compared to finished products that are imported. So it works against manufacturing.
There is also opposition from investors and businesses against Treasury's proposal to exempt Kenya Revenue Authority from obtaining personal data such as property and bank account details of taxpayers without a court warrant. Treasury argues that this is necessary to combat tax evasion.
The current structure is that if the taxman needs some information from you, they can go to court and get a court order and be able to get the information. And that process is working. So we are asking, why should we abandon it? What problem are we solving thereof? And there is also a concern on what safeguards have KRA put in so that in the event, and we obviously hope that it doesn't happen, that they get exempted from these laws, what safeguards are there that they will ensure that there's no data mismanagement?
President William Ruto is on record saying he targets Kenya to collect at least 22% of its GDP in taxes by 2027. However, the private sector insists that the current tax strategy needs to be relooked.
But then at what cost? We can do all these and we end up with a dead private sector. Then what then have we done for our economy? And what we suggest and advise government is that, yes, it's great to seek more revenue, but let's expand the tax bracket. And even as we do that, let's apply the same rigor and the same energy into the expenditure side. And let us monitor our expenditures. Let us cut down on our expenditures.
In Murang'a County, where Parliament's Committee on Finance is conducting public participation, residents are advocating for a business-friendly environment, particularly for farmers. Local leaders are also pushing for the inclusion of bursary consolidation in the Finance Bill 2024. The committee has until 28th of this month to conclude of public participation on the Finance Bill 2024. David Kagina, K24, Nairobi.
But I mean, it's a journey.